Good morning. I'm Tim Nyland, and today we're going to have some fun making sense of conflicting dynamics at play in both equity and credit markets. We're going to start by looking at what's behind the growth versus value trade as of late. Then we're going to move on to the record levels being set in the 10-year tips compared to what's happening with junk bond spreads relative to the 10-year Treasury. We will then move on to 8 points that will paint a very clear picture of what is happening in the markets right now. We will then quickly discuss 8 leading indicators to watch for signs of stagflation. That has been literally all the chatter in recent weeks. This is a webinar that you will definitely want to request a slide deck for so that you can reference all of the points in the future. Before we get started, please like, comment, and subscribe and come back every week for more videos on investing strategy and making the most of Zacks Pro platforms. If you would like to do the kind of analysis you're going to see in this video, then you're going to need to have a ZAT Portfolio Manager subscription, which includes both Zacks Advisor Tools and the Zacks Research System. Let's go ahead and get started. So this is a chart that you've seen before many times. The 10-year price and earnings chart, I should say 20-year in this case, price and earnings chart from the Zacks Research System is the page that I always start my analysis with. And the title of this slide here is the S&P value rotation over as fast as it started. And the point I want to make is that in order to understand what's going on in the tips market, in order to understand what's going on in the value space, you've really got to take a full synthesis approach to the market at this point. And that's literally what we're going to do in this webinar. So in looking at the S&P 500 price and earnings chart on the screen, you wouldn't realize that this value rotation is basically on pause. And the first clue to that would obviously be the growth rates that you see for 2021 coming from a 43% EPS growth in 2022 down to 9% and then back to 12% in 2023. But again, when you look at the price action, you'll see that the S&P 500 just continues to set new records every day, and we obviously all experience that. So again, you would not know that this value rotation is potentially over just as quick as it got started by looking at this chart. So what we need to do is we need to lift the hood a little bit and take a look at these cyclical names, these names that are more sensitive to the underlying dynamics of the economy. And we have many, many ways to do this. We'll do it with the Zacks cyclical portfolio. Again, this is one that I derive out of the standard industrial portfolio, and it's literally going to exacerbate the economic cycles for us so that we can get a true pulse of the U.S. industrial cyclical landscape. And you can see those cycles being exacerbated here with this EPS growth rate of 89% coming in for 2021, and then you'll see that precipitous decline in 22 down to 8%. So again, you can see that flat line here in those value names, specifically in the industrial complex. So this is something that we saw coming. I made this call several times starting many, many months ago, and it was all predicated on these FY2 estimates basically being revised down to the 8% range coming off of almost 90% growth in 2021. So when that happens, obviously we would expect a little bit of a tapering in the PE multiple expansion, which is exactly what we're experiencing now, okay? So what we're going to do is we're going to look for confirmation now of how the S&P 500 continues to reach new highs every single day, it seems, while the value trade is essentially on pause. And you can see that with the growth proxy, again, from the standard industrial portfolio, the 200 most earnings stable names out of that go into the growth portfolio, which is what you see on your screen. Out of that original basket of 400 from the standard industrial portfolio, the 200 most earnings unstable names is what's represented in the cyclical portfolio. So you can see here a much different story, that the growth portfolio or the growth basket of stocks is actually now carrying the returns of the S&P 500, okay? But remember, the work that I do on the standard industrial portfolio, when I go to produce the cyclical portfolio and the growth portfolio isn't necessarily indicative of the entire S&P 500. So what we're going to do is we're going to look for confirmation by actually looking at the S&P 500 growth and value members. And what I want everyone to see here too is that the growth rates themselves are actually carrying that price appreciation. You'll see that it's much less of a decline in growth in terms of momentum going from 2021 to 2022. So in 2021, we had mean EPS estimate change 24% off of actual earnings. In 2022, that's only going down to 13% versus what we saw with the cyclical basket, and I'll go back to it very briefly so you can see that, almost 90% down to 8%, okay, which is why we're getting that flat line. So again, now we want to do an additional confirmation and take a look at the SPDR portfolio, specifically the ETF composites that we maintain in the Zacks research system on the S&P 500 value ETF. And you can see that, again, we have confirmation of that slowdown in the value basket, okay, coming off of 53% to 9%. Now, keep in mind, the SPDR portfolio is going to have those financials. That's going to obviously mitigate that decline because there's still expected to be some growth in that group along with energy. Keep in mind that in the cyclical basket, we eliminate all of those sectors. It's a true pulse of the U.S. industrial economy minus those tilt sectors. So you can see 53% to 9%. Again, confirmation of that slowdown in the value group. And again, if we look at this from the growth perspective, the S&P SPDR ETF, growth ETF, you can see that we have confirmation of growth carry, and you can see that here in this price appreciation, okay? Previous slide, again, was the value ETF SPDR. You can see it was flat. We confirmed that with our cyclical portfolio. Now with the growth portfolio, we're again confirming that growth carry. You can see the price appreciation on higher levels of growth than the value group. So where I'm going with this is, should we be surprised that growth is now outperforming value? So while everyone on CNBC, Wall Street Journal has continued to say, yeah, continue to buy all the value names, continue to maintain the barbell strategy, we've had this just monster rally in growth. And you can see that as of year to date, in terms of actual ETF performance of the S&P 500 value versus growth, that growth actually overtook value sometime around the 4th of July. And it still continues to outperform value at this point. And so this is what that looks like from a trend perspective. So roughly since the 1st of May, we've been sitting flat. And it was about that same time that I made the call based on several things that I had seen. It's in prior webinars that growth was poised to begin performing, and certainly it has. And you can see that here, literally since about the 10th of May. Okay. So keep that in mind as we move forward. This is going to be an important point because it does relate to what's going on in the credit markets. And what I've seen here with tips, specifically the 10-year tips, is what triggered this webinar. And what caught my attention initially was back on August 3rd, we had hit the lowest inflationary adjusted yields in history for the 10-year Treasury inflation protected securities of negative 1.20. I know it's difficult to see that negative, but that is correct. It is a negative 1.20. We're going to talk about those implications here in just a minute. But what I'm showing on the screen is actually the history of the 10-year tips in the Zacks research system in our economic charting facility. And the point I want to make here is that these tips yields have been on the slide literally since the end of 2018. And so what we're doing now is we're pricing in that expectation for inflation to grow relative to levels of the 10-year Treasury. And you can see that's a pretty precipitous decline all the way down to current levels, which I checked yesterday, and I believe they were sitting at about negative 1.09. Monday, they were negative 1.16. So we were really close, again, to that 8.3 level of negative 1.2, which would mark that lowest inflation adjusted yields in history for the 10-year tips. So this is really significant. And when I saw this information, I was really struggling to put it all together when I started looking at all of these other dynamics in the market. Again, the whole point of this webinar, so stay tuned. It gets really, really good here. So the 10-year Treasury on 8/17, that would be Tuesday of this week, was sitting at 1.25%. So if we look at current TIPS yields, which on 8/17, which was the Tuesday of this week, yesterday, negative 1.09%, that would give us a current expected inflation over the next decade of 2.34%. So the calculation on the TIPS yield is effectively the 10-year Treasury minus the current expectation for inflation. So that's more or less how that works. So this is where it gets really, really interesting. So the negative TIPS yields, right? So why would anyone pay the U.S. government for the privilege of holding 10-year TIPS? And we have to think about it from this perspective. I've got two reasons up on the screen, but just let me summarize for you. The current 10-year TIPS yields represent the real inflation-adjusted return on the 10-year Treasury. So if TIPS are yielding negative 1.09% like they were yesterday, and the 10-year Treasury was 1.25% like it was yesterday, then the average inflation rate expected by the market is 2.34% over the next 10 years. So let me repeat that, okay? The current 10-year TIPS yield represents the real inflation-adjusted return on the 10-year Treasury. And if you think about it, it makes sense, right? If you're going to buy a 10-year Treasury today yielding 1.25%, and the expected average inflation rate over the next decade is 2.34%, your real inflation-adjusted return is negative 1.09, and that happens to be the current yield of the 10-year TIPS, and this is by design. So this is super, super important because what it essentially means is that investors are piling into TIPS, driving down the yield, and therefore betting on rising inflation, right? So no mystery there. That's what TIPS are for. I've got it bolded here. I've also got some interesting points, if you request the slide deck here, points A, B, and C on how TIPS actually work and what happens to the actual principal. It's amazing that the principal value of TIPS is more or less benchmarked against the consumer price index. So that rise in index or inflation, that will give you an actual principal increase or decrease with inflation or deflation. And even though the yield is fixed, the interest payments will vary because that rate is then applied to that adjusted principal. And so this is actually how these securities are inflation protected, right? But the moral of the story here, when you're looking at these market dynamics, is this current activity that's taking place in the TIPS market is essentially a flight to safety. And the idea here is kind of funny because you think about it, right? It means that investors will literally purchase TIPS with negative yields when they're concerned about losing their principal. I've got this in this 0.2 down here. And you know, in the face of this lower growth environment that we're in. So paying a small amount of interest for inflation protection is less costly than enduring principal loss. So that's the idea. Again, it's literally a bet on rising inflation. And again, what caught my attention here is that we were sitting at literally all-time record lows on TIPS yields. And then I'm looking at junk bond spreads, right? Think about this for a minute, because if you've got TIPS yields being driven to record lows, that's a risk-off trade, right? And you can see that junk bond spreads on the screen, again, using the research system economic charting, they've been driven down to record lows, and that's a risk-on trade. You can see the risk-off trade when we hit COVID. Everybody liquidated their junk bonds because obviously default risk skyrocketed at that point. And you can see the spread between junk bonds and 10-year treasuries just skyrocketing. So these are your risk-off trades, and these are your risk-on periods. And this low of 4.10 was set all the way back here in the Great Recession era we're literally sitting at 6.61, which is well below median value. So this is clearly a risk on trade. It's a massive risk on trade relative to 10 years. So this flies in the face and is contradictory to what's going on perhaps with tips. And so I'm sitting here trying to make sense of this, and we'll get to that here in just a few minutes. So the question at this point, when you're analyzing these spreads in isolation, is you ask yourself, how can these junk bond spreads be at record lows, again, risk on, while the tips yields are also at record lows, and that's risk off, right? There's three reasons for this. We've got negative real returns for 10-year treasuries. So investors are now forced to seek yield from junk bonds to actually get real return. And it's enabled by points 2 and 3 below, okay, that we have these high levels of market liquidity right now. These high levels of monetary and fiscal stimulus are providing this liquidity that's giving investors confidence that junk bond defaults will be on the decline. And so investors are piling into these junk bonds to take advantage of the reduced risk level relative to the yield. And again, we have an economy on the mend. This has also given investors added confidence that junk bond defaults will be on the decline. So 3 reasons why we are seeing this dispersion between junk bond spreads relative to the 10-year and the yield on the tips, okay? So how do we make sense of all this? What I want you to do, I'm going to walk through this very quickly. I want you to paint the following picture in your mind, okay? And again, please request this slide deck so that you've got this for future reference. So point number 1, right? We have economic growth that we know is forecast to slow next year. I mean, this has been broadcast for months. And it may even disappoint, right? We've heard that as well. This is not a surprise. But we know that this is also going to put the Fed in a bind when it comes to tapering or even tightening their policy stance in the face of what we're expecting to have is rising inflation. So we also know that corporate earnings growth is also forecast to slow next year, right? We know that. I just showed you the charts on the growth versus value trade. This is literally what's caused the growth group of stocks to once again outperform the value basket as investors are seeking those higher returns out of growth-oriented stocks. I showed you the growth is higher, and we looked at the actual returns of the S&P growth versus value ETF. And since about May 10th, we've had outperformance of that growth basket. So we have to keep in mind here points 3 and 4, because these are the disruptors. The supply chain keeps being extended, right? The supply chain disruption keeps being extended. Now some are saying it's going to last until 2022. Okay, that's going to continue to put pressure on inflation and prices. Same thing with the chip shortage. Now we're hearing from companies specifically that this disruption is going to be extended until perhaps 2023. And then who knows, next year it may go into 2024. We just don't know, but these are the things we need to keep our eyes on, okay? So this timetable that's been outlined by the Fed for months on end, by nature of the supply chain and chip shortage timeframes being extended, the timetable for what transitory actually means is actively being debated and extended each week. It is, if you haven't seen it, this is taking place not only at the Fed level, but by pundits in the media as well. And I'm in that camp as well. So this uncertainty is causing tips yields to slide, right? Now we're at our lowest point for inflation-adjusted 10-year yields in history, and we're pricing in more long-term inflation relative to current levels of the 10-year Treasury. That's exactly what's happening. And at the same time, we've got those negative real returns for 10-year Treasuries with risk of default being suppressed over the liquidity and recovering but slowing economy, pushing those junk bond to 10-year Treasury spreads down to record low levels. And the key point here is point number 8. And I want everybody to keep in mind that what I have highlighted here in yellow is really the key here of this entire picture, is that the long-term inflation expectation based on current tips yields remains moderate at 2.34% over the next decade, right? We calculated that, And you can calculate this yourself every single day. This will satisfy the requirement of that inflation expectation. I love to look at the 10-year tips because the 10-year time horizon is perfect for looking at long-term inflation rates. And we need to keep our eyes on this trend in tips yields for clues that inflation expectations are changing. And this is the perfect way to do it. So this is how we summarize and kind of make sense of all of these things that are taking place in the market right now. Okay. So there's been a lot of chatter about this concept of stagflation. I've been hearing it more and more lately. So the interesting thing is that everything that we've talked about is more or less a leading indicator of signs to watch for any indication that stagflation may be starting to get priced into a portion of the market. Okay. So the point here, we're going to go over 8 additional points very quickly. And I want you to realize that these are leading indicators. So I'm not going to mention unemployment, right? Because that's a lagging indicator. Okay. So these are the leading indicators, right? So economic growth. We would need further signs of economic growth slowdown. Remember, when you hear someone on TV or read something in the Wall Street Journal about panic and warning signs of stagflation, that this economic growth slowdown that we're going to experience next year, this is normalization. This is not slowing to the point of concern. Remember our indicators, right? ISM manufacturing, ISM services, these are at the highest levels we've literally ever experienced. Okay, so we are normalizing. We are not slowing down to the point of concern. Corporate earnings growth, right? We would also need a slowdown, and this slowdown would have to be much lower than the annualized rate of 7%, which is our 30-year median. Okay, so the idea here is that everything that we're experiencing in the cyclical space, this is merely normalization of corporate earnings growth back to that 7% long-term rate of growth on the S&P 500 for earnings. Okay, so again, we would need a massive corporate earnings growth slowdown before we would really want to start worrying about stagflation. Supply chain disruptions and chip shortage disruptions, right? My thing is we got to keep an eye on inventories, right? We've got to restock inventories just as much as we've got to fix the supply chain. And the inventory replenishing is going to take quite a bit longer. But any disruption continuing beyond current expectation would obviously continue to pressure prices and inflation. So those are things we need to keep our eyes on. The 5th point is that transitory inflation becomes embedded, right? This was the topic of an entire webinar that I did recently called the 2021 Inflation Playbook. If you haven't seen it, I would encourage you to watch it. I talk about worker-based compensation, or I should say worker compensation, consumer demand in the face of these supply chain issues and inflationary expectations. A really good webinar. Have a look at it. The point number 6, tips yields continuing to slide, right? If we were going to go into some sort of stagflation event and pricing for stagflation, we would see these tips yields go down even more. And this would obviously be relative to that 10-year Treasury. So again, current 10-year tips yields indicate inflation to be about 2.34% over the next decade. And you want to watch this trend relative to junk bond spreads and gold prices. So I've got that highlighted here in yellow for you. Super important, right? Because tips yields, junk bond spreads, and gold prices, when we're talking about stagflation, they kind of go hand in hand here. Junk bond spreads to 10-year, I should say junk bond spreads, yes, to the 10-year Treasury spread, they would rapidly increase. And again, keep in mind, when we're facing stagflation, we're talking about corporate debt defaults on the rise. So investors would unload their junk bonds relative to Treasuries, and we would see that junk bond to 10-year Treasury spread just spike. And obviously, we're not seeing this yet. Point number 8 is a really interesting one. I did this as part of my webinar on why traditional asset allocation doesn't work anymore. If you haven't seen that webinar, it's excellent. Please watch it. I talk about gold specifically, and the perspective I want everybody to take on gold is from more of a diversification aspect versus an inflationary hedge. The most recent period of stagflation that we did have, though, back in 73 to 79, gold was a top performing asset class. Inflation was up literally 9% annually during that stagflation time period, and gold investors gained 34% per year, and that is not a typo. It was real, 34% per year in gold. Keep in mind that other bouts of inflation that we've had since then, gold has not panned out to be a winner. So the verdict is mixed on gold's ability to be a good inflationary hedge. But the most recent evidence we have of the last stagflation period, gold was a real winner. Okay, so just keep that in mind. And if you haven't seen that webinar, why traditional asset allocation doesn't work anymore, please give it a watch. Go ahead and invest, or I should say, go ahead and request this slide deck. Again, it will be invaluable for you in the future, as these leading indicators are what I will be watching for any signs of stagflation as we continue to hear more and more chatter about this. Okay, so that's about it for this week. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or ideas for future videos, please leave a comment below or email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn and I'm on Twitter at Tim Nyland. If you're interested in getting started with Advisor Tools or the Zacks Research System, or you're looking to upgrade your current subscription, please contact our world-class support at advisortools@zacks.com and zrs@zacks.com. Thank you for watching, and I'll talk to you all next week.